Most financial content is built around excitement, what is surging, what is breaking out, what you might be missing. I am deliberately building something different. Retirement-grade investing is not exciting. It is disciplined, forensic, and it is designed to still be working when you need it most. The specific observation that made me run the numbers twice was the dramatic drop in local borrowing benchmarks to 1.08%. Everyone on the Zoom call was fully convinced that Singapore real estate investment trusts are an obvious, screaming buy right now. The macro tailwinds look beautifully aligned on paper, but the way most retail investors will act on this consensus is almost certainly wrong. When everyone in a room is rushing toward the exact same conclusion, that is precisely when a forensic investor needs to stop, step back, and verify the structural math behind the excitement. If you are chasing short-term momentum or capital gains, a higher risk trading profile may clear your hurdle. But if you are a retiree focused on wealth preservation and dependable drawdown income, my forensic standard is built to protect that. The reason this separation matters is simple. Chasing a price rebound and building a retirement income stream are completely different games with completely different rules. The institutional framework I use is not a universal condemnation of the market. It is a deliberate conservative filter designed specifically for individuals who are managing wealth preservation and cannot afford a major retirement setback. Most financial content chases the next headline. This framework is built for the investor who needs it to still be working 20 years from now. I attended this session as a guest of Longbridge, my platform sponsor. Everything that follows is my independent forensic REIT, not a product endorsement. Transparency is non-negotiable in this space, and my assessment remains completely unaffected by corporate relationships. Let's look directly at who was presenting the data and the specific product under review. In the world of dividend investing, we spend a lot of time talking about the yield spread, the difference between what a stock pays you and the risk-free rate. But there is a hidden leak that most retail investors completely ignore: transaction friction. If you are deploying 10,000 Singapore dollars into a Singapore REIT and your broker eats a chunk of that in minimum commissions or platform fees, you are starting your investment in the red before you have even bought a single share. Data is only useful if you have the tools to act on it without getting eaten alive by those fees. That is why I use Longbridge. They are currently the only platform in Singapore offering lifetime zero commission for US, Hong Kong, and Singapore stocks. Their data visualization is also some of the fastest I have used, which is critical when you are timing an entry in a volatile market. To help you plug that leak, I have partnered with Longbridge on an exclusive arrangement for my viewers. For the first 10 viewers who open and fund an account with a minimum of 10,000 Singapore dollars, Longbridge is offering a direct 100 Singapore dollar asterisk cash credit on top of their already generous June welcome rewards. Here is what the full package looks like if you deposit $10,000, hold it for 90 days, and complete 5 buy trades. You receive the exclusive $100 cash credit. You receive 300 Singapore dollars worth of NVIDIA fractional shares. You receive a 5% per annum interest boost coupon valid for 365 days on deposits up to $4,000, worth up to 200 Singapore dollars over the year. And you receive platform fee coupons worth up to 450 Singapore dollars across US, Hong Kong, and Singapore markets. All of these stacked together. You do not have to choose between them. Why does this math matter to a forensic investor? Because $100 on a $10,000 deposit is an immediate 1% day one yield boost before you have executed a single trade. Combined with the interest boost coupon hash and platform fee savings, the total welcome package meaningfully neutralizes transaction friction and protects your margin of safety from the moment you fund the account. This is strictly limited to the first 10 spots. The link and full terms are in the description. Other fees and terms and conditions apply, so read those carefully before you proceed. But for a forensic investor who cares about entry cost and yield from day one, this is worth 5 minutes of your time. Now let's carry on with the rest of the video. Let's begin with the areas where the institutional perspective aligns perfectly with mathematical reality. The structural shifts are real. The cost pressures that hammered property trusts over the last 3 years are showing genuine signs of reversal. The first core tailwind comes down to the local interest rate framework. The first argument Bruce Yang raised centers on the dramatic shift in local interest rates, specifically 3-month SORA. That is the 3-month Singapore overnight rate average, the volume-weighted average rate of borrowing transactions in the local cash market. The fund manager noted that 3-month compounded SORA is currently hovering near cycle lows at approximately 1.08% as of late June 26, sourced from MAS published data. From a forensic perspective, this interest rate argument is entirely sound and maps directly to what my framework tracks via the interest coverage ratio, which measures how many times a company's operating profit can cover its outstanding interest payments. Many property trusts that locked in fixed rate debt at peak borrowing costs 3 to 5 years ago are now facing a wall of refinancing. Rolling over this debt today becomes structurally accretive to interest coverage and distribution per unit simultaneously. This is a mechanical cost savings flow, not speculative market growth. According to mass data cited during the session, real estate investment sales rose 10% quarter on quarter and over 100% year on year to 15 billion Singapore dollars in the first quarter of 26 alone. This liquidity surge confirms that the operational environment is thawing. Trusts currently sitting in Zone 3 or Zone 4 may see their gate metrics improve significantly in the next earnings cycle. This is not an immediate zone upgrade, but it is an authoritative watch trigger. The second core argument is the valuation discrepancy. S-REITs across the sector are currently trading at an average price-to-book ratio of approximately 0.9 times. Historically, when the Singapore property trust sector has drifted into the 0.8 to 0.9 times range, it has consistently triggered institutional support and a subsequent price recovery over the following 12 months. More importantly, the sector-level yield spread versus the Singapore 10-year government bond yield stands at approximately 390 basis points, based on JP Morgan survey data cited by the fund manager. With the Singapore 10-year government bond yield currently sitting at approximately 2.1%, the index indicated yield is pushed to around 6%. This wide valuation cushion is exactly where our framework looks for real mispricing in the open market. This 390 basis point spread is the most forensically interesting number of the entire session. My personal framework requires an equity position to yield a minimum of 150 basis points above my static 3.2% forensic floor to clear the 4.7% minimum yield hurdle. A sector-level spread of 390 basis points above the risk-free benchmark indicates that the market has priced in a massive risk premium. We want to deploy capital when spreads are wide and fear is present, not when spreads are tight and the risk-reward ratio is poor. The final valid point from the presentation addresses execution simplicity through a diversified index wrapper. The iEdge S-REIT Leaders Index provides instant exposure to 23 distinct trusts across the industrial, retail, office, data center, and hospitality subsectors. This underlying revenue exposure is diversified globally across Australia, Hong Kong, the United Kingdom, Japan, and the United States, with a strict 10% cap per security to prevent concentration risk in any single mega-cap name. The product data shows a meaningful 15% allocation to data centers, capitalizing on structural tech demand. For an investor who does not want to spend their weekends reading through hundreds of pages of financial statements, this ETF approach offers a legitimate structural advantage. An ETF is an exchange-traded fund, a basket of securities traded on the stock exchange just like individual shares. It averages out asset quality across the entire ecosystem. While it sacrifices forensic precision by forcing you to own some weaker assets alongside the high-quality ones, it drastically reduces execution complexity. If you want to know exactly what you own and why, you must run our framework on each stock individually. But if your goal is simple, low-friction sector exposure, a diversified index vehicle solves a real retail need. The fund manager is entirely accurate regarding the SORA tailwind. When borrowing costs drop to 1.08%, the mechanical pressure on interest coverage drops with them. This is why institutional money is returning to the sector and driving massive transaction volumes. But remember, an index fund does not differentiate between a well-managed trust and an over-leveraged one. It buys everything to match the index. For a retiree relying on cash flow consistency, indexing cuts down research time, but guarantees you are holding lower-tier assets that fail our balance sheet gates. A lower interest rate environment helps everyone, but it helps high-quality balance sheets first. Now let us look at where my forensic framework pushes back against the institutional narrative. While the macro data points are verified, the tactical advice given to retail market participants introduces a completely different set of risks. And here is where the professional advice and the retirement income framework completely part ways. Bruce Zhang's closing recommendation for retail participants was to actively buy more on large market corrections, hold steady on rallies, and harvest the volatility over the next 3 to 6 months. This is a professional trading stance dressed up in traditional income investor language. That distinction matters enormously for my audience. A buy-the-dip strategy assumes 3 distinct operational realities that simply do not align with defensive asset deployment. A buy-the-dip strategy assumes 3 things. You have liquid dry powder sitting idle the exact moment a market correction occurs. You possess the timing precision required to execute trades during heightened volatility. And you have the stomach to deploy capital when headlines look terrifying. For a 58-year-old retail investor in Bedok managing an active SRS drawdown, none of these assumptions are realistic or safe. My framework takes a fundamentally different position. If the macro case for property trusts is valid, the primary question for an income investor is never about timing a short-term market dip. The question is whether the specific asset under consideration clears our non-negotiable forensic gates at today's market price. An asset that successfully clears the yield hurdle, stays safely below the gearing ceiling, and maintains a solid interest coverage ratio at the current market price does not require precision timing to make the income thesis work. The rental distributions will arrive in your account regardless of whether your entry point was at the absolute low of the week or the high of the month. The fund manager's trading approach is designed to optimize for capital gains at entry. Our forensic approach is designed to optimize for durable, predictable income across a multi-year holding period. The question is never about when to enter. It is about whether the asset clears the gate at today's price. The second point requiring strong qualification is the headline distribution figure. The presentation highlighted an annualized indicated dividend yield of approximately 6% on the CSOP SRT ETF, with distributions paid semi-annually in February and August. The next ex-dividend date is expected in mid-July 26, with the cash payout to follow in late August, though the fund manager noted the exact date was still being finalized as of the session date. For a retail investor planning a strict CPF drawdown schedule, that yield number looks incredibly attractive. But the word indicated is doing an immense amount of heavy lifting in that sentence. An indicated yield is an unaudited estimate based on historical index performance and forward assumptions. It is a starting point for analysis, never the final conclusion. Our forensic framework demands that we look directly through the index wrapper down to the individual holdings. We must verify if those underlying distributions are being funded by organic net property income, meaning the rent that the properties actually collect after adjustments, or if they are being artificially sustained by temporary sponsor top-ups and engineered yield support mechanisms. We must inspect whether the individual payout ratios are sustainable and if individual gearing levels can withstand an unexpected refinancing shock. The ETF structure blends all the numbers together, hiding the weaker individual performers inside the index average. This is not a structural flaw of the ETF product itself. It is a fundamental reality of index investing. If your retirement security depends on the absolute certainty of that income stream, you cannot afford to skip the forensic layer that looks at what is actually supporting the cash on the table. What this means for the income investor. Let me translate everything we have covered into 3 plain language takeaways you can act on today. Takeaway 1. The macro is genuine. 3M compounded SORA sits at approximately 1.08% as of late June 2026, near cycle lows. The sector is trading at around 90% of book value, a 10% discount. And the yield spread versus the Singapore 10-year government bond stands at 390 basis points. These are not manufactured numbers. The structural headwinds that battered property trusts over the last 3 years are genuinely dissipating. Takeaway 2. What you do with that depends entirely on your objective. If you are running a trading book and want to play short-term volatility over the next 3 to 6 months, the fund manager's advice is perfectly logical. But if you are building a retirement drawdown portfolio, the playbook is completely different. Ignore the short-term noise. Acquire individual assets that clear our forensic zone gates at current market prices. Those are 2 different games and they require 2 different frameworks. Takeaway 3. The ETF solves an entry problem, not a quality problem. The CSOP SRT ETF carries a fund size of approximately 130 million Singapore dollars and a total expense ratio capped at 60 basis points per annum. That is an efficient tool for hands-off sector exposure. But efficient is not the same as safe. It does not replace the security of a targeted, forensically audited portfolio where you know exactly what you own and why. And before we close, there is one more distinction that every income investor in this community must carry with them. I call it the legacy hold distinction. Every forensic zone assessment I run is anchored strictly to what a new dollar of capital buys today at current market prices, not what a position purchased 3 or 4 years ago earns on its original cost. If you bought Singapore property trusts at higher valuations back then, your yield on cost is a completely different number from what fresh CPF or SRS capital earns if deployed right now. Our analysis always addresses the new dollar question. If you are allocating new money today, you are playing a different game from the legacy holder sitting next to you at the same void deck. The fund manager at this session delivered a genuinely credible, data-backed macro overview. The strongest signal in the entire presentation was the 390 basis point yield spread, confirming the sector is structurally undervalued on a relative basis. The weakest link was the buy the dip recommendation. That is a trading framework designed for capital appreciation. For a retirement income investor who cannot afford to misjudge market entry, it introduces unnecessary execution risk. The macro case for S-REITs is largely right. What you do with it depends on whether you are managing a trading book or a retirement income stream. Now, a common question worth addressing directly If CPF special account is already maxed out, why does the 4.7% yield hurdle still apply to the dollars sitting outside the CPF system? The answer is that the hurdle has nothing to do with what CPF will or will not pay you. It is the minimum return that justifies the risks you are taking on by being in the open market at all, gearing risk, distribution cuts, and the possibility of permanent capital loss. Those risks do not get cheaper because your CPF headroom is exhausted. The market does not offer you a discount for running out of guaranteed options. An indicated yield is an unaudited estimate based on historical index performance and forward assumptions. It is a starting point for analysis, never the final conclusion. Our forensic framework demands that we look directly through the index wrapper down to the individual holdings. We must verify if those underlying distributions are being funded by organic net property income, meaning the rent that the properties actually collect after adjustments, or if they are being artificially sustained by temporary sponsor top-ups and engineered yield support mechanisms. We must inspect whether the individual payout ratios are sustainable and if individual gearing levels can withstand an unexpected refinancing shock. The ETF structure blends all the numbers together, hiding the weaker individual performers inside the index average. This is not a structural flaw of the ETF product itself. It is a fundamental reality of index investing. If your retirement security depends on the absolute certainty of that income stream, you cannot afford to skip the forensic layer that looks at what is actually supporting the cash on the table. An indicated yield of 6% is an institutional billboard, not a guarantee. The ETF structure handles execution beautifully, but it completely strips away your ability to apply a forensic gate. When you buy an index with 23 names, you are buying the top-tier fortresses along with the highly leveraged trusts that are barely scraping past their covenants. If a single underlying trust cuts its distribution by half due to an unexpected asset impairment, your total index yield drops and you have no say in the matter. For a true drawdown portfolio, blind diversification is a poor substitute for individual balance sheet safety. And here is what I want to leave you with. Sitting in that room on Wednesday, I was reminded of something that does not get said often enough. Institutional fund managers are not wrong. They are optimizing for a different objective. Bruce Zhang's macro framework for S-REITs is genuinely well constructed. The Sora tailwind is real. The valuation spread at 390 basis points above the 10-year government bond yield is the most compelling number I have seen in this sector in a long time. And the transaction volume data confirms that the operational environment is thawing. If I were running a multi-billion-dollar allocation desk, I would be paying close attention to everything he presented. But I am not running an allocation desk, and neither are you. We are building forensic portfolios for Singaporeans who are 5 years from retirement or already in it and who need every dollar of their SRS and CPF OA to work reliably across a 10 to 20-year drawdown. That investor does not need a better trading strategy. They need to know which individual assets clear the balance sheet gates at today's prices, and which ones are riding the macro tailwind while quietly carrying gearing levels that will hurt them when the cycle turns. The sector case and the stock level case are two completely different questions. Wednesday's session answered the first one well. The second one is what we are here for, and that is exactly what we will keep doing. This video is a paid partnership with Longbridge Singapore. It is intended for general awareness and does not constitute investment advice or a recommendation to buy, sell, or otherwise engage with any investment products or financial services. The author is not a licensed financial advisor and is not offering financial advice. All views expressed are solely those of the author and do not necessarily reflect the views of Longbridge Singapore. All investments carry risks, may not be suitable for everyone, and you may lose your investment principal. Past performance is not indicative of future results. You should seek independent financial advice if you are unsure about any investment decisions. This advertisement has not been reviewed by the Monetary Authority of Singapore.